29.2 or 28.4, which you're seeing right now.
Right. So that roughly 150 to 200 basis point margin could have been better, which we should see from the next 4Q onwards.
Next
right?
Next year onwards, yes.
Okay. Okay. Then it's a great show, right? Great show. That's it from my side. All the best.
Thank you.
Thank you.
Thank you. The next question is from the line of Anuj from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good set of numbers, sir. So 3 questions. Firstly, on your new and reimagined business, especially TajSATS and Ginger, which has clocked in almost 2x of growth versus our standalone entity. So what has been the growth driver and are they sustainable going ahead? Also, any new segment where TajSATS has scaled up its reach, which actually has led to such kind of a robust growth? And what will be your outlook for this entity going ahead? Secondly, any impact of ongoing elections which we are witnessing across Tier 1, 2 or 3 cities across ARR and occupancy? And lastly, we have already surpassed our Avant target a year ahead. So what margin, portfolio addition or portfolio mix do we see or expect for next year, sir? Thank you.
Hi. Giri here. So I think, as far as the first question on Ginger and TajSATS are concerned, I think there are a number of drivers. As far as Ginger is concerned, Ginger Mumbai Airport is obviously a big driver. The second thing is that we were upgrading properties from the old model to the new Lean Lux model. That has clearly driven. And third, from an F&B perspective, we have kind of graduated from the earlier format into humans actually, which has also helped in terms of growth. I think these factors will continue to grow in our capital light, fully fitted lease models on Ginger actually. So Ginger actually, we are very excited in terms of the opportunity to grow. That is number one. As far as TajSATS is concerned, once again, a number of drivers, very, very clearly, the growth in the number of airports, the growth in the airline passengers, the kind of mix which is happening, and the way we are charging our customers between, meals as well as handling charges. So I think there are a number of factors once again. And productivity, most importantly productivity. Places like Delhi, as an example, there have been significant productivity improvements, which kind of ensure that we're able to do more meals given the same space actually. And TajSATS will continue to have that momentum completely actually. As far as this year is concerned, I think Puneet has outlined in terms of the factors for this year. Very clearly, I think there may be some temporary impacts in terms of elections and all that, but otherwise, I think we do not see, given the long-term fundamentals in terms of demand drivers, in terms of supply drivers, I think we are clearly standing by the double-digit revenue growth that we've spoken about actually. And I certainly think that, I think a lot of what has been happening is, in the industry, there's momentum versus strategy. I think as from our perspective, I think we have a solid strategy, we have solid execution, and we have a number of factors coming into play. The diversification in terms of top line, the 125 city presence, which gives us a lot of network effects as an example, the productivity in costs, all of these are going to come together in terms of driving our performance actually. And I forgot the third question. These are the 2 questions.
So it was on the Avant target, which we have already surpassed a year ahead. So going ahead, in terms of our portfolio mix, because the last call we actually had targeted to have 55-45 kind of a ratio between the asset light and asset heavy. We are already at 60-40. So going ahead, what would be our target in terms of this proportional mix? And also any target on or outlook on the margin pressure would be helpful.
As far as the growth is concerned, we will continue to grow. I know there is a chart very clearly we're talking in terms of the capital light and capital heavy. I think including pipeline, if you see the capital heavy is 28% actually, and capital light continues to be 72%. So that is going to be the driving force unless some new opportunities like inorganic and other things come into play, or new greenfield kind of opportunities actually. So that's the guidance. And as far as the margin is concerned, we have been very clear that the margin for us is an outcome rather than a target actually. We had to give a target 5 years ago because we were at 17%, and therefore it was important to give a target and deliver actually. Now, having achieved the 33%, I think we should, it is more an outcome. If as a result of the action that we take with the leverage on the, operating leverage, if the margins go up, there will be an outcome actually, rather than a target. So I think that's the way to kind of look at it actually.
Okay, thank you, sir. And this your gateway would again be on the asset-light model?
Yes, at the moment, the 15 that we have highlighted, they are all on asset-light.
Thank you, sir. That's helpful, and thanks for the opportunity. Wish you good luck.
Thank you.
Thank you. The next question is from the line of Bharat Sheth from Quest Investment. Please go ahead.
Hi. Congratulations, Puneet and team. My question is first on this IT spend. So if they have to really look at ROI, or so is it for creating more business or also including cost saving? So if you can give little more color, and how do we see its payback time?
So IT spend, as you see, what we've outlined here, there are 2-3 big areas. Basically, the ERP software, which is really the heart of the financial software. We are upgrading it to the most modern software, which is the S/4HANA RISE, and we expect it to actually give us a lot of productivity gains once it is fully rolled out across our portfolio. And these could be things like implementing a shared service, and getting cost savings as we scale up. Parallelly, we are also doing a PMS upgrade, which is basically moving on a very modern upgrading from a current PMS which we have onto a on-cloud PMS. Again, this will go hand in hand with the ERP upgrade. And I think the benefits of this you will see over the next 2, 3, 4 years, because this is not something which is you see the benefit immediately, because it's a thing about productivity and savings which will flow into the P&L over a period of time. And I think as an organization, we've been leaders, and therefore for us to maintain leadership, it is important that we are ahead of the curve and spend on IT and productivity investments. And that is why this has been called out this year particularly.
One question for Puneet. Normally our Q2 is a very soft in history, but since last year we have seen that Q2 is little better, over a YOY, or maybe much better, and decline is not to which was earlier. So how do we see the trend, a quarterly trend, and what is really playing out that all the quarter may come, maybe not equal, but a decline over, previous quarter, changing in the seasonality?
See, there are 3-4 things. Number one is India is now not anymore talking October to March destination. It's becoming a 12-month destination. Okay. Number 2 factor is that companies, including us, we don't wait till October to start making money. We start thinking about profitability. Historically, 20 years ago, 25, 30 years ago, it was like this, that we'll wait till September, October, November. So that is changed completely. I think it's true for the entire sector. Number 3 change is new destinations are coming up. So, there was not so much airports, roads, trains, infrastructure, all the spending that is making all these destinations in India accessible. So it doesn't matter, if it is hot, you can go to the hills. If it is cold, you can go to the south, you can go to Goa. So, India has 7,500 kilometers of coastline. It has 500 plus beaches. It has a mountain range which is massive. It has a spiritual destinations with almost 3 million plus possibilities of people to go and visit on spirituality. So a lot of that is changing with the affluent India, which is getting the flavor of becoming the 5th largest economy. And if it is going to become 3rd, so all these factors of taking short breaks, spending discretionary spend on leisure will drive the change of hospitality from a discretionary sector to a consumer sector. That's what it is in very simple terms. And that is what is going to change your Q1, Q2. Q3 will remain strong with Diwali and all the wedding season. And Q4 also will always be the first and second strongest quarters. And events like IPL also help. I have to say that these events, India becoming a sports destination, whether you have World Cup hockey happening for women or you have Kabaddi Championship or IPL or, all these things are helping. And at the same time, the supply is not coming at that speed as the way it came earlier. So of course, hotels will get built, but we have a few years definitely where the demand-supply imbalance is going to stay. So all in all, this is really what is helping us from an infrastructure point of view, but also our own growth. We are adding so many hotels per month now. Going forward, we are saying we will do more than 2 hotels a month. And if those 2 hotels are coming, majority is coming in capital light, it just keeps adding. With the flow-through becomes higher.
Yeah.
So that's something we have been saying for now 5-6 years in a row.
So effectively, does it mean that it will improve our RevPAR for annualized basis from the whatever was the history?
Normally it should, but as I said, at the moment there is nothing that suggests the contrary. And based on a Horwath HTL report, as I said in the opening remarks, the demand is supposed to grow at 10.6, which historically grew at 6.4%. So I think that should help.
Thank you and all the best.
Thank you. The next question is from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. I've got 3 questions. Firstly, if I look at slide 17 of your presentation, and Puneet, if you could talk more about the supply narrative, because I was going through an article, and effectively, if you look at the top 5 international hotel chains and their growth aspirations for next 3 to 5 years, we are looking at close to 450 hotels that are getting added, effectively 50 to 60,000 keys that are being added by these hotel chains. So in that context, how should we think of this narrative about supply remaining constrained over next 3 to 5 years?
I would recommend very strongly to get some of these announcements made for the last 3, 4, 5 years and then compare it to reality. It has not yet happened. Right? We have had this question since 2018 in different hospitality forums that I participate in and in other calls. This is one of the ways of, international way of marketing and getting the thing. Maybe it happens, but up till now it has not. So it's very easy to go back and check. And I think a few days ago there was an article in, Mint, which gave the number of hotels in operation of the top players and the number of hotels in pipeline. I think that's what one has to do. And in the pipeline also you have to keep adding, because 100% of the pipeline never gets built, no matter where in the world. So you have to look at, depending on the quality of the pipeline, a 70 to 80% number is a very strong number, because something happens. Somewhere some protest comes, somewhere some PIL comes, somewhere, some developer, promoter runs out of money or ends up in some other issues. So things happen in a marketplace, or a flooding happens, or what a cyclone comes, things just change. And I would say this is what you've been reading is thanks to a recent investment conference that happened, where a lot of people came and they made these statements, because India is a happening place. Everybody wants to have a share of that growth and the possibility to participate in that growth, so that nobody gets left behind. And it's good competition to get. But I think the number of hotels we have in pipeline, we are way ahead of anyone. And these are signed, legal, binding contracts that we announce. This pipeline is not projects which are under negotiation. We have another 90 under negotiation. So that is not what we count. Of the number of projects you have in negotiation, if that's 10, then the ones you actually conclude, you're very lucky if you conclude 20 to 25%.
And the other thing, Karan, is that you should also look at the micro markets actually. Ultimately, hotels are a micro market business. And if you look at our hotels in our micro market, there's effectively no new supply coming in. I think that's number one. And number two, in all the key markets, we dominate in terms of the number of hotels as well as the price points actually. and therefore our ability to cater to different customer segments is also very high. So looking at supply alone as a standalone way of looking at it is not right. You have to integrate it with all the other factors actually.
Sure. This is helpful, Giri. My second question, given the significant surge in airfares, especially post-COVID, almost 50% versus pre-COVID, how should one think about the ability for hospitality chains to continue driving ARR's growth, given the ADR is also up 30-40% versus pre-COVID? And as a follow-up, at what point do you think international destinations perhaps become more attractive or more lucrative in the context of rising airfare and hotel rates?
I think if you look at our own portfolio, if you see the slide we put out by brand on ARRs and occupancy, you will see that if you look at the Taj Business Hotel, that segment is a 13,700 average ARR for Q4, and if you look at it for the full year, similar number. So I think we believe that there's still room to grow, and ARRs is a function of demand supply at the end of the day. And like Giri said, not only supply across the country, but what's the supply in the upcoming micro market. And if you look at last 4 years or 5 years ARR increase, a lot of it is also because there's been high inflation in the economy, which has also led to ARRs that inflation being passed on to the customer. And that ability to pass on inflationary increase is there till the time you have a good balance on demand supply. And I think that's something which we feel confident will remain in the foreseeable future. So I think if you think about it more conceptually, I think the ability to increase ARR is still there. And of course, it will vary from hotel to hotel. It is not going to be uniform across the market. And it will vary also from segment to segment, and which, whether it's leisure or whether it's which brand we are talking about. So I think that's point one. Secondly, I think if you look at last year's data, there's been fair bit of outbound travel from India, which has actually exceeded the pre-COVID level. In spite of that, we've had, we've continued to sort of grow and see RevPAR go up over the last 12 months. So I think that does show that while, destinations outside India are attractive for some people, there is still enough demand in the country, and whether that's business demand or leisure demand, which is kind of, catering to our hotels. And couple of things which are hidden or which are potential upside is that we still are not back to our foreign inbound tourists, right? We are still, the statistics is about 85% of what was pre-COVID, but that also includes the push we got from G20. If you were to adjust it for that is probably down to 70-75% of the pre-COVID level. So there is, and that should actually pick up. I think if you look at again various forecasts of that, this year itself they should pick up, and then over the next few years, we expect that to actually get to almost like a 27-28 million tourists coming to India. And that is a big push a big factor which will help us sort of fill in some of our leisure properties, which are already doing well but can obviously do better. So I think those are some of the other factors you should just think about, and as you think about ARR's growth, because it's not about just one quarter or the full year, but I think what's the long-term trajectory.
And just building on what Ankur said. See, we have always said that from a business ARR perspective, there's enough scope, because really speaking, if you travel abroad, you see for the same kind of rooms and kind of quality, I think our pricing is much lower. So I think with the growth in business, I think the potential to increase business ARRs is definitely there. On the leisure side, it represents the long-term opportunity in terms of growth. See, the domestic resilience, as Ankur pointed out, is very real actually, which means that people are taking more trips, they're taking shorter trips. And many times when people take these holidays, they're not thinking of a destination. They have teams in and they want to go to some place actually, whether driving to destinations or what. And when you look at these 2-3 day trips, especially, what happens is that people have a wallet in mind, saying that I will spend about 1 lakh for this trip as an example. Then it doesn't matter, Karan, in terms of whether the ARR is 10,000 or 12,000 actually, as long as the wallet is maintained actually. Hence, I think, and remember one thing, the ARR is really all about the part of the business. 45% of our business is room revenue. There's everything else in terms of F&B, in terms of all the asset-light businesses, the banqueting, the chambers, and a whole bunch of other things actually. And hence, I think don't look at it narrowly in terms of just ARR and RevPARs actually. I think there are multiple factors, and this is where I think the diversified network, the size of the network, is going to matter. If you are a 2-hotel chain, then I think some of these factors, what you ask, are very real actually. But when you are 125 cities operating with 200 hotels actually, I think with a whole bunch of network effects actually. I think these are all one of those factors, but eventually there are a number of, factors which complement and supplement actually. Hence you need to look at it much more holistically actually.
Sure. And Giri, lastly, if you think of, your strategy to reintroduce the Gateway brand, do you reckon, given the sort of 2,500 crores gross cash on the balance sheet and the kind of free cash flow that you're projected to generate, perhaps thinking about acquiring a hotel chain operating in tier 2 and tier 3 cities would have been a better strategy, or you think that building a brand or reimagining Gateway is the right way to go forward?
I think we have just begun with 15 hotels and Gateway as we have announced. Inorganic opportunities is something that we'll always be looking at for the right price and value.
One thing does not exclude the other. Yeah. So the evolution of our brandscape is ongoing. And, what was only known as Taj Group, see how it has evolved, and we will continue to evaluate as and when opportunities arise. Now, we have launched Gateway, but I think you're saying it's acquiring tier 2, tier 3 cities brand. There are not many. And there are not many available for sale. So if there is one, then, and it's on the market, then you can be sure that we will be a candidate which will go for it.
Fair point. The other thing, Karan, is that, I think with our size now, I think to some extent we can start talking ourselves as a consumer business actually, which means that, and the reason I'm saying that, Karan, is that ultimately India is a heterogeneous country with different requirements. A Tree of Life caters to a certain segment, a Gateway caters to a certain segment, which we were hitherto not able to service. And hence I think what we are doing actually is expanding the pie. And that's the only way to look at it. And when we have a slide also in the presentation about not just about the number of hotels, it's not just about serving different customers, but also different price points. That also matters. Because the beauty of the price point thing is that it is not margin dilutive. If you go to Ginger, well, ARRs may be lower, but it is margin accretive actually. So I think you need to look at all of these factors. I think it's almost becoming like a consumer business at this point in time.
Sure. This is helpful. Thank you and all the best.
Thank you.
We will take maybe one last question at the most, and if there is none, then we would like to close the call.
Sure. The last question is from the line of Prashant Biyani from Elara Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, between business and leisure, where do you see more scope of improvement in occupancy?
I mean, if you see the structural trend, and you pointed out the demand slide, that the long-term growth driver is there for both, but leisure should outstrip business side. If you look at that slide, which basically, kind of gives you a sort of a clue as to where the long-term demand is going to be from the various segments. I think if you look at our own hotels, you can see that there is occupancy for various cuts. So there is room for improvement, I guess, in both, but leisure probably can do a little bit better in terms of occupancy in the long term.
No, I agree. In fact, I think if you look at leisure, I think if you go in the month of June as an example to a Lake Palace, earlier a June month would be a low month actually, but now domestic consumers are going, and many of these destinations are now becoming all-round year destinations actually. So leisure does, and also look at our mix of business. Today, 75% of our business is still in the business segment and 25% in leisure. Therefore, I would imagine that with the long-term opportunity and our presence in different leisure destinations, and we have the widest presence in the leisure destinations actually, I think therefore the opportunity in leisure structurally is much better.
Right. And sir, in the next 3 to 5 years, which of your hotels can become as big as the big 5 machines of slide 32?
Slide 32.
Which is all the big machines. Yeah. I think which additional hotels will come into this kind of a top 5 bucket?
Many.
Yeah, exactly.
So I think we are opening many big machines. If you look at the development with Bangalore International Airport, which is not owned, it's a management contract, but we have a combo development of Vivanta and Ginger totaling 750 rooms. We're doing almost 300 rooms in Ekta Nagar, which is owned. We're doing a big one in Cochin Airport.
Ginger.
We are doing, just now signed and announced the Ginger Mopa Airport in Goa, 300 rooms. So we are doing big boxes. We are very much looking forward to, as nobody asked this question today, so I will mention it as it's the last one, to the redevelopment of Sea Rock, which would be at least 2 of these big boxes on slide 32 alone. So, these kind of boxes, they take time. And that's why Sea Rock will take a bit of time, but it will happen.
And maybe some of our existing hotels, which are currently loss-making, potentially have an opportunity to come into this big box. And, basically, which is currently not on the slide, but could come on the slide if we are able to turn around some of those hotels.
Right. Sir, just extending this, all of these are basically in large cities and owned by us. So, except for Sea Rock, are we looking at adding any new large hotel owned by us at a city location in the Taj or mainly?
Yeah, we are working on it. Maybe we have an answer in the next quarter or so. We are working on a very large opportunity in leisure segment, and actually not one. We are working on 2, and let's see which one as a company owned. So where we have the land already for almost 30 years with us. There are some planning issues, just like the Sea Rock. We have 2 such large projects, and we have to just do the building. So it's not acquisition of land, and so it will be like a Ginger Mumbai Airport, where we had the land. So it's a part of our asset management initiative. So let's see where it gets to. We are putting in a lot of effort there, and hopefully at least one of those 2, if not both, works out in the next quarter.
Sure, that's it from my side. Thanks.
Thank you.
Thank you.
Thank you. I'd like to thank everyone who joined the call today. Should we have more questions or other people who didn't have a chance, please feel free to reach out to Giridhar Sanjeevi, Ankur Dalwani, or myself in the next days. We'll be happy to take any questions that you might have. Thank you for joining in, and thank you for listening and for all your support. And have a wonderful evening.
Thank you. On behalf of the Indian Hotels Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your line.